You are holding a stock that has fallen 10% from your purchase price. You tell yourself it is a temporary dip, a healthy correction. The market is just shaking out the weak hands before the real move begins. Your analysis, you reason, is still sound. This feeling, this warm and comforting belief in a future recovery against all evidence, is hope. It is the most expensive thing you can own on Wall Street. On the other side of the ledger, you have a stock that has risen 20%, a quick and satisfying gain. Anxious energy floods your system. You feel an overwhelming urge to sell, to lock in the profit before the market snatches it back. You can already feel the sting of watching it fall back to your entry price. This feeling, this cold and urgent need to escape with what you have, is fear. It is the reason you will never make big money. These two impulses, hope and fear, are the architects of ruin for the uninformed trader. They ensure you sell your winners too soon and hold your losers too long. They are the reverse of what is required. In the market, you must fear your losses will grow and hope your profits will expand. The average man does the exact opposite. He hopes his losses will shrink and fears his profits will vanish. And for that, he pays a terrible price. The human mind is not built for speculation. It is an instrument of pattern recognition, but also one of emotional storytelling. When a trade goes against us, our ego is wounded. We are wrong, and admitting we are wrong is a painful act. Hope is the anesthetic for that pain. It allows us to rewrite the story. The market is not telling us we are wrong. It is merely testing our conviction. The stock is not weak. It is consolidating. These are the fictions we invent to avoid the simple, sharp pain of taking a small loss. Hope transforms a simple trading error into a committed investment. You become a long-term investor by accident because you could not bear to liquidate a position that had moved a few points against you. This is a fatal flaw. A speculator cannot afford the luxury of hope. He deals only in facts, in the numbers on the screen and the volume that accompanies them. The tape tells a story, and it does not care for your version of it. When the tape says you are wrong, you must listen and act without emotion. To hold on to hope is to argue with an avalanche. The outcome is preordained. Fear in a winning position is just as destructive. It stems from a history of small losses. The trader has been conditioned by the market's random fluctuations to believe that any gain is fleeting. He has seen profitable trades turn into losing ones so many times that his primary instinct becomes one of self-preservation. He seeks to capture any profit, no matter how small, simply to feel the relief of being right, of winning. He sells a stock that is behaving perfectly, a leader in a strong group that is just beginning its real advance, for a paltry 3 or 5 point gain. He feels clever for a day, perhaps a week. Then he is forced to watch in agony as the stock moves another 50 or 100 points without him. The big money is not made in the small swings. It is made by identifying a trend and having the courage and patience to ride it to its logical conclusion. Fear makes this impossible. It convinces you to step off a speeding express train at the first local stop, while the disciplined speculator rides it all the way to the end of the line. Your goal is not to scalp a few points. Your goal is to capture the great movements. Fear is the enemy of that goal. It whispers that you should be content with crumbs, when you should be waiting for the entire loaf. I remember the period after the Great War. The demand for industrial goods, particularly steel, had been immense. Stocks like Bethlehem Steel and United States Steel had seen moves that were biblical in proportion. The public believed the boom was permanent. They reasoned that the rebuilding of Europe would require just as much steel as the war itself. It was a compelling story, and for a time the market seemed to agree. Let us consider a stock of that era, call it Allegheny Rail and Steel. It had run from $50 to $150 in a year. The newspapers were full of talk about its prospects. Everyone from barbers to bankers owned a piece of it. But then something changed. The volume on the rallies began to shrink. The price would push to a new high, only to fall back immediately. The strong, persistent upward march had turned into a labored, volatile struggle. The tape was communicating a change in character. The large interests who had accumulated the stock at lower prices were now distributing it to an eager, hopeful public. The stock would dip from 150 to 140. The crowd saw this as a buying opportunity. "It's on sale," they would say, full of hope. They bought more. The stock then broke below 140 and slid to 125. The hopeful held on. "The fundamentals are still good," they insisted, ignoring the clear verdict of the market action. They were listening to their own narrative, not to the facts. Hope was their guide. Meanwhile, the prudent speculator, who understood the language of the tape, saw the broken trend. He saw the weakness on rallies and the increasing pressure of selling. His stop was at 139, just below a key support level. The moment it was breached, he sold his entire line. He did not ask questions. He did not hope for a bounce. He took his loss, a small one, and moved to the sidelines in cash. He was now objective, unemotional, waiting. The hopeful, however, rode Allegheny Rail and Steel all the way down, from 125 to 100, from 100 to 70, and finally to 40. At each new low, their hope became more desperate. They averaged down, throwing good money after bad, convinced that each decline was the final bottom. Their initial small error in judgment, amplified by hope, resulted in a catastrophic loss, an account blow-up from which many never recovered. They held a piece of paper that represented their dreams, and hope prevented them from seeing that the dream was over. They paid for their education, and the tuition was everything they had. Fear played its part too. Many who had bought the stock at 60 or 70 sold at 100. They feared the first 10-point correction, and it cost them the next 50 points of the primary advance. They made a profit, yes, but they missed the real money. Both groups, the hopeful and the fearful, failed. Only the one who listened to the tape and acted on its message with discipline survived. Understanding this dynamic, the internal battle between hope and fear, is the core of market wisdom. It is the psychological foundation upon which all successful speculation is built. I can explain the why your own mind becomes your greatest enemy. I can show you how to cultivate the mindset of a professional operator, to be cold, patient, and decisive. This is my role, to give you the discipline and the mindset. But for the precise mechanics, exactly where, how, and when to execute the trade, you need the structure of Richard Wyckoff. He was a contemporary of mine, a titan of tape reading. His methods provide a logical framework for analyzing price and volume, for identifying accumulation and distribution, for knowing with high probability when a major move is about to begin or end. He gives you the tactical tools to apply the strategic principles. I have left the link to his channel in the description below. Use it to complete your arsenal. Psychology without technique is powerless, and technique without psychology is a blunt instrument. You need both. Jesse Livermore, or Larry Livingston as he was known in print, consistently stressed that Wall Street extracts a heavy cost of instruction for every lesson learned the hard way. Fortunately, the core principles he developed to survive these expensive market penalties were captured for posterity by Edwin Lefebvre in the 1923 masterpiece, Reminiscences of a Stock Operator. It stands as the finest possible literary training ground, allowing you to absorb decades of painful operational experience without ever having to risk $1 of your own capital. To ensure this timeless wisdom translates accurately to the modern, computerized arena, we advise seeking out the Max Davidson Annotated edition. Davidson's careful commentary is indispensable for bridging the gap between Livermore's era and ours. A link to this essential edition is provided in the description below. So how do these ancient traps manifest on your modern screens? They are the same, just faster. The hope trap today is holding a legacy industrial company that has been in a downtrend for months, simply because you read an article claiming a new technology will revitalize their business. The facts on the chart show relentless selling pressure, lower highs and lower lows. But the story in your head, the hope, tells you to hold on. The fear trap is selling a leading semiconductor company that has just broken out of a year-long base on tremendous volume. You are up 20% in 2 weeks and you get nervous. You sell to lock it in just before the stock begins a 6-month 200% advance that defines the next bull market. You let fear cheat you out of a life-changing gain. The solution is not to become an emotionless machine. That is impossible. The solution is to build a system of rules that operates independently of your emotions. This system becomes your fortress against hope and fear. First, you must neutralize hope in your losing trades. The tool for this is the stop-loss order. Before you ever click the buy button, you must determine the exact price at which your idea is invalidated. This is not an arbitrary number. It should be a technical level on the chart, below a key support level, under a prior swing low, or beneath the low of a breakout bar. This price is your line in the sand. If the market touches that price, you are wrong. Period. You do not think. You do not reconsider. You sell. The sell order should be placed immediately after your buy order is filled. This act of pre-commitment, of making the selling decision while you are still rational and objective, is what saves you from the paralysis of hope when the trade goes against you. A small loss is the cost of doing business. A large loss is the result of undisciplined hope. Second, you must manage fear in your winning trades. The tool for this is the trailing stop. Never sell a stock simply because it has made a large and rapid advance. A stock is never too high to buy nor too high to hold if it is acting correctly. Instead of selling everything, you protect your gains with a trailing stop. As the stock moves higher, you move your stop loss up with it. You might place it under the low of the previous week or below a key moving average that has been supporting the trend. This method gives the stock room to breathe, to have normal pullbacks and consolidations while protecting the bulk of your profit. You are no longer making the decision based on your fear of giving profits back. You are allowing the market itself to tell you when the trend is over. When the stock finally breaks the uptrend and hits your elevated stop, you are sold out automatically. The decision is systematic, not emotional. This is how you ride a winner for its full duration. This is how you make the big money. What if you find yourself already caught? What if you are listening to this now, looking at a position that is down 30, 40, or 50%? You are deep in the hope trap. The first and most difficult step is to admit your error. The money is already gone. The number on your screen is just a reflection of reality. Clinging to the stock will not bring the money back. The hope that it will come back to even is a siren song leading you to further financial ruin. You must sell the entire position. Liquidate it. Today, the pain will be sharp, but it will be finite. It will free not only your capital, but more importantly, your mental energy. You cannot think clearly about new opportunities when you are psychologically anchored to a past mistake. Sell it. Accept the loss as tuition paid to the market and start fresh. Do not, under any circumstances, average down. Averaging down is the act of rewarding failure. And what if you are on the other side? You sold a winning stock for a small gain, and now it has tripled. The regret is a bitter pill. You feel the urge to jump back in, to chase it, to capture what you missed. Do not. Chasing a stock out of fear of missing out, FOMO as you call it now, is a cardinal sin. You're entering at the point of maximum risk long after the prudent entry point has passed. The solution here is not to correct the individual mistake, but to correct the process. Analyze why you sold. Did you have a plan? Did you use a trailing stop? Or did you let your fear dictate your action? Learn the lesson. The next time you have a strong stock that is acting right, you will have a plan in place. You will not let fear chase you out. You will let the market take you out only when the trend is well and truly over. In the end, the market is a battlefield, but the primary conflict is not against other traders or unseen forces. It is against your own human nature. Hope and fear are deeply ingrained instincts that served our ancestors well, but they are liabilities in the world of speculation. They cloud judgment and compel disastrous decisions. Your task is to subordinate these instincts to a logical, tested set of rules. You do not conquer fear and hope. You simply render them irrelevant by adhering to your discipline. You become an observer of the market's behavior and a strict executor of your own plan. The tape tells you what to do. Your rules tell you how to do it. Your emotions are mere spectators, not participants in the decision. That is the path to mastery. It is a difficult path and a lonely one, but it is the only one that leads to consistent success. Stay disciplined.